Hello, everyone, and welcome to today's session. Happy Monday. Hopefully, everybody had an amazing weekend. I know Esmeralda is in the class, and she's the one who started us off in the community, just saying Happy Monday to everyone. And this is going to be a productive week. Hopefully, we have a lot of sessions going on through the Circle community, and also I'll be sending out later a link for our Negozi. I will do a session with Negozi on Thursday, but they do have a 2-day event and they're providing me a link and hopefully a coupon code for our community. But I will share that with you for later this afternoon. Hopefully, those of us can be present and join in for those 2-day sessions of tax law updates. And I'm spearheading a session based specifically on becoming a Schedule C to become over an S corporation. It's a 1 hour session. So hopefully I get to see you there. But with that, we're going to get started with our Monday session. Today's session is really important because it talks about retirement accounts. And I know sometimes even ourselves, our clients, we don't see retirement in the near future. We're just constantly working and just thinking about one day being able to retire is something that we will deal with when it comes to time, which shouldn't be the case. As we know, as we've learned, especially my personal experience with my parents, is that they never set money aside in a retirement account. And all they're receiving right now is Social Security benefits. Those are not enough to live off of. Social Security benefits, please do not depend on those. And who knows by the time you and I retire if those are even going to be available for us anyway. So today's session is going to focus on how we can prepare for retirement, what are the different options when it comes to the tax law, and how we can advise our clients when it comes to retirement. But with that, if we have anybody new in our session, I'm here to introduce myself. My name is Nadia Rodriguez. I'm a CPA based out of Dallas, Texas. I've been with my solo tax practice for over 15 years. And just recently, as of this year, it's going to be about 4 months now, that I did jump ship and left the corporate world, where now I am fully dedicated to my tax advisory and tax compliance tax firm, where before it was only my part-time gig, but now it's full-time. But I am also the founder of the Nadia CPA Inner Circle and the lead instructor for Tax Training Academy. Because my goal with these two communities that I have is to bring us together as tax professionals, share our insights, share our knowledge, and help each other out. Because what we know is that tax professionals to today's day, we are in high demand. Not too many people are getting into our industry, and there's a lot of taxpayers that do need help with their tax compliance and tax advisory. So, welcome today to our session. We're going to start off with just some facts. 46% of those Americans in the US or citizens, US residents here in the US, have not saved any money for retirement. 46%. Now that's pretty scary and pretty common too if we talk to our clients or those friends and family around us. Again, this is something that we usually kind of push off until the end, that maybe if we're getting close to retirement age and don't really worry about it in today's day. But we should. There's an opportunity for us as tax advisors, as tax professionals, to start bringing up the conversation with our clients about how and what are their plans for retirement. Because next thing we know, we've learned time flies. Next thing we know, that time will come near and we don't have anything for savings. So if we talk about retirement accounts, because there's different ways that you can save money for retirement. Yes, maybe you can put it all into a savings account and just generate interest. But when we talk about retirement accounts, the government does have different initiatives to help us and motivate us to save for that retirement because they want the taxpayers to retire. And the tax code does implement some laws and benefits and make it a little bit more of an incentive for us to save. So, understanding the retirement accounts, it's not just about having the tax impact, but it's really about us as tax advisors empowering our clients to reach their financial goals because they might have a vision of what their retirement will look like. But how to get there, that's where we step in and advise them on the different options that they have. Now, there is a fine line between being a financial advisor and being a tax advisor. Here in Texas, you cannot give out tax or financial advisory services and charge for them if you are not a certified financial advisor. But as tax professionals, we can educate our clients with the different options and the tax impact of those different options. Now, if they're asking us, where do I put our money? That's where we step into being a financial advisor role, which again, here in Texas, we're not allowed to do. So at that point is where we partner with someone or with a company on how they can help them. And we do the handoff that they can help them, but we can come in and explain the tax impact of saving for retirement. When it comes to retirement accounts, you can see them divided into three sections: tax deferred, tax free, and taxable. The tax deferred, we know that we're not paying tax on this today, but we will one day when we start pulling that money out. Tax free is that when we pull that money out, are we going to pay any income tax? There are options where we don't pay income tax. The growth or any contributions into those retirement accounts will be completely tax free. And that's what I like. That's my preference. And we're going to go over that. And of course, the taxable, right? We're not paying tax today, but there's no escape. We're going to pay for tax on that distribution of retirement accounts eventually. Now, when we talk about clients and they're asking us, well, where does my money go when it's in a retirement account? There's so many options. And that's something that they can get together with a brokerage firm, with an advisor on where that money would be allocated. But here are the most common ways that your retirement money inside of your fund is most likely invested in. It's invested in stocks, bonds, mutual funds, ETFs, which is very similar to mutual funds, CDs, cash. There are real estate investment trusts or self-directed assets, which there are options like that in a retirement account that you alone can say, I want this money to be directly invested into a bunch of real estate and not really stocks or mutual funds. So there are different options, but really the bucket, which is the retirement account, how that is organized, that's where we step into the difference between traditional accounts, Roth accounts, and different options that we have. So we're going to go over those. If we look at the type of retirement accounts, there's traditional IRAs, which is individual retirement accounts. There's Roth IRAs. There's employer plans, which we're very familiar with, the 401ks, the 403bs, or if you are self-employed, we have those SEP IRAs for you and those solo 401ks as well. We have the brokerage accounts where we can also invest and put money in to save for later. The whole purpose of this is that we're having our money work for us, right? We're putting that money aside instead of just putting it under a mattress where there's not going to be any growth. And there's a lot of risk of keeping that money saved somewhere that is not a secured place. When we talk about employer sponsored plans, the most common, the 401k, who offers it? The employers, those that are in the business for profit, in the business. The tax treatment, it's usually pre tax or Roth, depending on your employer. Most of the common retirement accounts, 401ks that I have seen, it's pre tax, which means it's not going to be part of your taxable wages in this year if you contribute to a 401k, but it's just going to be in there saving, getting saved for you, getting invested in different kind of funds, and then start growing. And when you do get the money out at retirement age, or if you're not going to wait until you're 59 and a half, then there is a penalty when you take it out. Not only the penalty, but we're going to learn that you also pay federal income tax on those withdrawals that you do out of your 401k. The 403b is about the same. The only difference is that who holds it or who's the one that offers it. It's not going to be a for-profit business. Instead, it's going to be the nonprofit, the schools, the hospitals. A lot of the teachers, if you have teacher clients, they are the ones investing in a 403b, not in a 401k. The 457b, it's also very specific to government agencies that are the ones that sponsor these type of retirement accounts. The simple IRA, they're offered for small businesses, small employers, which means you can't have more than 100 employees in order for you to offer this type of simple IRA. And they are a lower cost to manage versus the 401k, which can be pretty expensive for an employer to manage. The simple IRA is a more affordable option for them. And also the employer has the discretion of doing employer match. They can match you up to maybe 3% of how much you contribute into this. You, the employee, contributes into this type of account. And then we have the solo 401k, which is really by definition solo. That means that it's only self-employed individuals that can set up solo 401ks and there's no employees. Now, if your spouse is your only employee, then you still qualify for this. But once someone else outside of that steps in to become an employee, you can no longer be qualified to have a solo 401k. What they do allow is high contribution limits. We're going to learn with the traditional IRA and the Roth IRA, there's so much money that you can put in per year where you are able to take a deduction on your tax return. When it comes to a solo 401k, and those here that you see, the 401k, 403b, those contribution limits are higher, way higher, more in the 20,000s that you can actually contribute into these retirement accounts. And so how do the employers contribute? Again, it's up to their discretion. And sometimes we do see that individual taxpayers kind of shop around with employers on who offers the best match. And that can be an incentive for employers on offering this type of benefit of matching contributions into these retirement accounts to try to get more people to come and work for them, because it's a nice incentive. They can do employee matches, 100% of your first 3% that you do match, that you do contribute into these retirement accounts. They can do profit sharing contributions, where instead, depending on the amount of income that's coming in through the month, they can have some kind of discretion of how much to contribute and help you fund your retirement account. And then non-elective contributions, where the employer actually contributes even if you, the employee, doesn't contribute into these type of accounts. So at this point, I think a really good familiar conversation for us to have with our clients, just to find out when we get their W-2, we have that conversation with them, especially if we do notice that their retirement plan checkbox is selected on the W-2. Ask the question, what type of retirement account is this? Do you know how much are you contributing and how much does your employer match you? Because here in this example, we see box 1, your taxable wages for this example is 68,000, but box 3, your social security wages is higher, it's 71,000. And the difference between those two is what we see on box 12 with the code D, the $3,000 that was contributed into a 401k plan. And this is a conversation that I have with my clients. I see that you contributed $3,000 to a 401k, which is great. You're saving for retirement. Do you know what the employer match is on that? Because all of that employer match, it's free money. You'll never see the employer contributions to your 401k on a W-2. You're not taxed on those contributions. That really is free money for you. Of course, we'll pay tax for it when we retire and take the money out, but the initial contributions are not taxable to you. Because what do we know about our tax law? The general rule is that we get taxed on every kind of income that we receive, any kind of ascension to wealth. So it's free money, but we don't get taxed on it because we do have a tax law for that exempts that income to be taxed. So at this point, we do know that it's not part of taxable income, what you do put into your 401k. Box 1 is what makes it to your 1040 as a wage income. We're not going to pay tax on $3,000, but again, it's only a tax deferred account. Eventually, the tax will have to get paid. And so that steps into traditional IRAs. These are individual retirement accounts that are tax deferred as well, just like what we think about with the 401k. We put money in, we can take a deduction on our tax return against our income, which in turn lowers our adjusted gross income. But again, it's deferred. Now, this is a great tool, a tax planning tool, because we're lowering our adjusted gross income. And what do we know with the One Big Beautiful Bill? That the 4 new deductions that are coming through depend on your adjusted gross income. If you have too much of a gross income, you might not even be allowed to take those type of deductions that came with the One Big Beautiful Bill. So if we're really trying to lower our income, the traditional IRA contributions can help us with playing with those numbers of decreasing our adjusted gross income. With the traditional IRA, we can contribute up to, we see the amounts here on the right-hand side, in 2025, up to $7,000 per year. Or if you're 50 or older, you can contribute $8,000 per year. Starting next year, it goes up, and these amounts get adjusted year after year. If you see in 2026, it's $7,500. If you're under 50, or if you're 50 and over, it's $8,600, the max that you can contribute into a traditional IRA. Now, can we take a tax deduction on the amount that we put into this IRA? It all depends on what if we are sponsored by another employer for a retirement account. And we're going to see that right now. But it could be fully deductible or just partially deductible or not deductible at all. And we'll look at the rules for that. It's a tax deferred growth. Sounds nice today to receive a deduction, but again, that money is going to be waiting to be taxed one day. Not only is that contribution going to be taxed one day, but the growth on it. Is it invested in mutual funds? Depending on where it's invested, it could be gaining that money and still being deposited into the same account. And then the growth keeps on getting reinvested and keeps on growing. But when you do take that money out, that's where the federal income tax gets applied to. And of course, if you live in a state that imposes a state income tax, you would also have to pay some state income taxes on that. So you have to have earned income to participate into a traditional IRA. For you to contribute up to the 7,000 and then look to see if you can receive a deduction towards your income on that, it has to be earned income that you have. It's not like all you can do is maybe put money in a savings account and have interest income generated and that's what you live off of. If you don't have earned income, you cannot contribute into a traditional IRA. And then you also, the deduction that you can get on your 1040, the 7,000, depends on the total amount of earned income. If your total earned income was 5,000, but you only contributed 7,000, you can only receive a deduction up to 5,000. It can't go past what you have in earned income. But the great thing about this is that the spouse, if you're married filing joint and only one of the taxpayers is working and is earning that earned income, the non-working spouse can also participate and have their own traditional IRA and contribute into it, as long as we have enough earned income to make those contributions. Now, here at the bottom, the required minimum distributions at age 73. This is what we have now for Secure 2.0 Act. It used to be a lower age, now it's 73. So what happens is that you can have a traditional IRA, have this money in your retirement account, and you're still 73 and you still want to work. That's okay. You can continue to work, and maybe you say, I don't want this money from my retirement account yet. I'm letting it sit there, and one day I will take it out, but not when I'm 73. Well, we have the required minimum distribution. When you do turn 73, you have to, by law, you are forced to take that money out. Not all of it, but there is a formula of how much money you have to take out at that age. You can't just let it sit there forever. And eventually, if your plan is to pass it down to your heirs when you pass away, we have to at least have been taking money out at the age of 73. So when we talk about the deductibility, if you do invest 7,000 a year, that's the max for 2025. Can you take a deduction on your 1040? It all depends. You, the taxpayer, or if you're married filing joint, the taxpayer and the spouse, if either of you are sponsored by an employer plan, so one of you is still working with the 401k employer, then at that point, we go down this route of yes, you are covered by an employer 401k or 403b, another employer sponsored plan. Then you have to check your AGI limits. Depends on how much money your adjusted gross income is in there. Because if it's too high, then you can't take a deduction. If it's somewhere in between, and I'll show you the chart right now, then you can, that 7,000 of a tax deduction, even though that's how much you put in there, we won't be able to take the full $7,000 of a deduction. If we're below the limit, yes. Even if we're sponsored by another 401k, another employer plan, we will be able to take 100% of that deduction. But it depends if our modified adjusted gross income is low enough, depending on the chart given to us by the IRS. Now, if you are not covered by any other employer, maybe you're self-employed and this is your very first time saving up money for your retirement and you open a traditional IRA. At that point, you can make a lot of money. You can be a very high income earner with your Schedule C business. You can put in 7,000 and still receive that deduction of 7,000 because you are not covered by another employer sponsored plan. And so here's the chart that we see. You see single individuals, if they are covered by another retirement account through an employer sponsored, if their income, their modified adjusted gross income is less is $79,000 or less, then yes, they can take that full $7,000 of a deduction. But then it keeps on going down with those ranges. Again, these tables are adjusted for inflation year after year, but we see here for married filing joint, if either of you are either the taxpayer or the spouse are covered by an employer sponsored plan, we do see that over $146,000 of modified adjusted gross income, there's no deduction. Distributions. Well, we say until you reach the age of 59 and a half, can you take money out of that retirement account without a penalty? Of course, you still have to pay income tax because it is a tax deferred account. But if you are under the age of 59 and a half, and this is scenarios that I do come across with clients, one, they were not aware. And even though they talked to the brokerage firm when they take money out and they probably warned them and they held 20% of withholding on that distribution, they forget. But yes, there is a penalty that has to get paid if you're under the age of 59 and a half and you get money out of your retirement account, including a traditional IRA. Now, there are exceptions to the rule of not being subject to that 10% early withdrawal penalty. And some of the most common, you'll see them here, which we did have new this year. 2024, I believe, was the first year we did have new exception, was the domestic abuse victim, and also the eligible emergency expense. If you have a financial hardship, there is a 10% exception for that. Of course, you still have to pay income tax, but at least you're not paying the penalty. And there's several of these exceptions. There's like 2 pages worth of exceptions that you'll find when it talks about the 10% early withdrawal penalty. Now let's look at the Roth. This one is my favorite. The Roth IRA, it's one of those that let's just take care of something today and then we don't have to worry about it. The Roth IRA, you don't get any deduction. Remember the traditional, we're talking about entering a distribution of 7,000 and then you can get a deduction on your 1040 for 7,000. For a Roth IRA, you can make a contribution. You're not going to get any tax deduction today. So you're still going to pay income tax. But you know what? It's going to grow tax-free. So all of those contributions into a Roth and the interest, the dividends, all the capital gains it's generating year after year, when it comes to retirement age or the age of 59 and a half, at that point, you can start taking money out. There's no tax on not only the contributions, but the growth of that account. So again, to me, this is a very powerful retirement account. Of course, if we're more at the higher income tax bracket today, where we want to lower our income because we want to pay less taxes, we might go to the traditional route, traditional IRA, to reduce that AGI and pay less taxes, but just know there's no escape. I would rather rip the Band-Aid today and actually go in and pay the tax today, because who knows, the way our US federal system goes, what have we seen about tax rates? They're not going down, right? They're either staying pretty steady or just keep on increasing a little bit more. Never have I seen a year where our tax tables come down completely. So we know that adjusted due to adjustments in inflation and our tax brackets, it's not going to get any better for us on paying less of a tax bracket in a future year. So it is tax-free growth. There's no lifetime required minimum distributions. The original owners of this Roth IRA, you're not forced to take that money out, like I said about for the traditional IRAs, right? Because why are they forcing you to take the money out at age 73 for a traditional IRA? Because the government wants to start collecting money on those contributions that you've been putting in, and you took the benefit of a tax deduction. With the Roth, it's different, right? We paid our tax. There's no in contributions where we skipped the tax part, so there are not going to be any required minimum distributions. This type of plan, yes, it's ideal for those younger clients that usually when you start off your career, or even if we have kids that we're hiring, right? We're hiring our own kids, they're earning income. They're going to be taxed at a very low tax bracket. So might as well pay that low tax today and contribute into a Roth IRA and let it sit there and grow tax-free, instead of waiting and taking that deduction today and having to pay the tax later, when you know that once they get more experience in their type of career or their field, they're going to be getting paid more and be subject to a higher tax bracket. So the contributions here of, can anybody be an owner of a Roth IRA? If you can contribute to a Roth IRA, it's not meant for everyone, as in it's not allowed for everyone. This amazing benefit of growth tax, having it grow tax free, if you're a high income earner, and this is what they mean by high income earner, at that point, you cannot contribute into a Roth IRA. If you see here, just for a single person, if they're making either 161,000 or more for the year 2025, at that point you're not allowed to make any contributions into a Roth IRA. And I see here at the bottom where it says, even if maybe the taxpayer was not aware, maybe the brokerage firm or the bank where he did or she did open that Roth IRA and contributed this amount, even though their AGI was greater, at that point, they can be subject to a 6% excess contribution penalty for contributing to a Roth IRA when they were not really allowed to. They were phased out because they're considered high income earners. Oops, I'm going backwards, sorry. So the distributions, if you do put money into a Roth IRA, right, you are allowed, you're eligible. At that point, can you take money out? Because you've already paid the tax on those contributions. You can. You can take money out, but of course, we have to first meet two rules in order for us to take money out of a Roth IRA without having to pay the early withdrawal penalty. Because what we learned is the magic age is 59 and a half. If you're under 59 and a half and you're taking money out of your Roth IRA, it won't be subject to the 10% penalty if you have at least had that Roth IRA open for 5 years, and also if the distribution is made after 59 and a half. So when we take money out of a Roth IRA, we've already paid tax, remember, on the contributions, but the growth that happens, you can take that money out, but we do have to pay income tax because you are not the 59 and a half yet. So if we look at the difference between the two, we compare them side by side, the traditional IRA and the Roth IRA. The traditional IRA, like we said, is generally tax deductible, right? The contribution, you can deduct $7,000 if you max it out year after year. But I do say generally, because remember, if you are an employee and you have an employer sponsored plan, that's where we have to look at the income limits that you have in order for us to determine if it's 100% deductible or partially deductible or not deductible at all. Roth IRA, there's no deduction at all. Contribute the $7,000, but you won't be able to take a deduction on your 1040. The contribution of tax, you get the tax break now. Again, you reduce that liability, that tax liability with the traditional IRA. With the Roth, we have already paid tax. We're not going to pay tax again. The growth status for a traditional IRA, tax deferred. There's no escape on that tax. You take a deduction, the IRS is going to want their money back plus more. They're going to tax you on the growth and on all of those contributions. Roth, tax-free. You won't ever get taxed on the contributions because you've already paid tax, but then plus the growth. It's an amazing deal because you don't have to pay tax on that either. The withdrawals and the traditional IRA, they're taxed on your ordinary tax rates the year that you do take that money out. So yes, maybe at retirement age or at 59 and a half, you are subject to a much lower tax bracket than today. At that point, you got a deal, right? You're going to pay lower income tax because you did receive a deduction when you were subject to a higher income tax rate at retirement age. That's where we come in with planning. If we know that our client is going to take money out now at 59 and a half out of their traditional IRA, we're incentivized to figure out how we can decrease their taxable income because we know that the distributions out will be subject to this ordinary income tax. When it comes to Roth, 100% tax-free. The required minimum distributions, when you're age 73, with the traditional IRA, you have to take those out, not with the Roth. Now, with the traditional IRA, yes, the primary goal is to lower income today. But with a Roth, it's to have that tax free growth on our retirement account. Now, there is a strategy because honestly, when I learned about Roth, I said, I want to participate in Roth today. And I want to advise all my clients about Roth. But what did we learn about Roth retirement accounts? Is that not everybody can participate if you're a high income earner. And we saw in the previous slides, the high income earner is not really high what we think about, right? Having a married filing joint couple earning more than $250,000 or more, they're considered high income earners to me. And that's honestly where, especially in the cost of living in a state like California, that's not really high income earners. So yes, you are classified high income earner and you're not allowed to contribute to a Roth IRA. However, there is, many people sometimes call it a loophole, which don't ever use the word loophole like in front of an audit or anything for an IRS agent, but it's really a tax law that's there for us. It's never been corrected, and really the history just says maybe this was just some mishap and nobody really noticed it, and they've never really paid too much attention or want to come back and correct this, or I guess I can say close that loophole. But this is something that is allowed for those high income earners, and it's called the backdoor Roth IRA strategy. So the step number one is that we're going to contribute into a traditional IRA. Remember, a traditional IRA, you're not going to receive a deduction for that. We're going to contribute into a traditional IRA. And step number two is you convert that IRA, those funds that were contributed there, you're going to convert them over to a Roth IRA. You can't contribute directly into the Roth IRA. It really has to go through these steps first. Now, the perfect situation is that the day that you contribute the money into a Roth IRA, a traditional IRA, you're not going to receive a deduction. But as soon as that money gets funded in there, the idea is to go ahead and transfer it over to your Roth IRA. Because the planning strategy behind this is that you don't give it time to grow. Because once it starts growing, that traditional IRA starts earning some money. And if you wait maybe 3 months and it's had some growth, that income, we're going to have to pay income tax on that because the growth can be converted over to the Roth, but the income tax will have to get paid. The perfect situation is that it has zero growth and right away we convert it over to a Roth. Now, we do have to file every year that we do this type of conversion. We have to file the Form 8606 so that we can report how much that we contribute into the traditional IRA, how much did it grow, if any, and then how much are we converting over to the Roth. Now, I have seen taxpayers that they have pre-tax funds before. Maybe they did fund a traditional IRA for years and years, and they were able to benefit from that deduction. And so they have a traditional IRA, and do we want to convert all of those funds over to a Roth or to a Roth IRA? Most likely we do, but it all has to come with strategically planning for this. So let's look at an example for this because here at the bottom, I do say the pro rata rule. We have to pay income tax on that growth. But it's not just like you can pay income tax on specific amounts that you want. We have to apply a specific formula on the Form 8606. If we look at an example for this, we have a high income taxpayer. They're not eligible to do a direct contribution to a Roth. Remember, they're phased out and they're covered by a retirement plan at work. So they've on their own wanted to open their own traditional IRA and then convert it to a Roth. So they have existing traditional IRA balances of 93,000, and this year they contribute another 7,000 into the traditional because that's your step number one. It has to go through a traditional IRA first. So at the end of the day, they have $100,000 in a traditional IRA. That year, we decided to convert only $7,000 over to the Roth. Even though we convert it right away as soon as we deposit the last 7,000, we still have to apply the pro rata rule because that fund, that traditional IRA, already had pre-tax contributions in it. And so at that point, at the end of the year, we're going to take all of the traditional SEP accounts, simple IRAs, to determine what our basis is for the entire investments. And we apply this formula where we take we have to compute what the tax-free portion is. So we contributed over, or we rolled over 7,000. We're going to have to take that 7,000 over the $100,000, which is our total balance, and then we multiply it times the 7,000 that we actually rolled over. Only $490 of that will be tax-free. The rest we do have to pay income tax, because remember, we have this huge bucket of 93,000 of traditional IRA funds that had been just growing and growing, that one day we did receive those deductions throughout the year. But when we convert it over to a Roth, it's going to have to be a portion of some of the pre-tax and then some of the one that was not pre-tax. So that's how this formula works on the 8606. And thank goodness for tax softwares, because that's what it handles in the background. We just need to make sure that we're checking the math, that it's doing it correctly. So we have just here a few couple scenarios that I can leave with you that talks about different clients that we have. You know, you have those that are, especially the younger ones that are not in the high tax bracket. Let's incentivize them and help them with opening a Roth IRA. Now, again, we won't be able to help them do that unless we are financial advisors, or we partner with the financial advisor to help them on walking them through on how to invest and where to invest. But at least we bring that conversation up of the amazing tax benefits of a Roth versus a traditional IRA. But I'll leave you with this. The last thing I do want to cover is tax credits. The Savers tax credit. This is allowed, it's a non-refundable tax credit. It's a federal tax credit, and it's allowed for those low to moderate income taxpayers. Now, if you look at the bottom, what that income limit is, it's not very high, right? So if you have a married filing joint couple, there's no credit for contributing into a retirement account if the married filing joint modified adjusted gross income is greater than 73,000. So it is for those lower income earners. Anything that you contribute to a retirement account, if you are under these limits of being a low income earner, then your credit of how much you're contributing into a retirement account, how much you're saving up for retirement, can be a credit up to 50%, 20%, or 10%. And here we see the different columns depending on how much income you have. So the maximum credit that you can get on your tax return, your 1040, is $1,000 towards your tax, or $2,000 if you're married filing joint. Of course, it's not refundable, so it's only up to your tax liability. But that gets claimed on your Form 8880. Now with that, I do want to introduce you to a special guest that we have today. We're talking about retirement accounts and the amazing benefits of it. Not only, yes, we get a tax deduction, but just saving that money for retirement. Something that I think our clients need to get better at recognizing that one day they are going to retire. We're not going to be able to work forever. And what better accomplishment than putting in the work today to then later be able to retire and not have to worry financially too much about how to pay the bills. And so our special guest today, Amir Tassini, he's going to come to us and talk to us about Crecer. Crecer, I'll let him introduce himself, but we met in one of the speaking engagements that I had at a tax conference, and he gave me a demo of his app, which I love because it's English and Spanish for those clients that speak Spanish. And it really makes it easy on how to even just take that first step of funding a retirement account. But with that, I'm going to pass it on to Amir.
Thanks for having me, Nadia. Great presentation as usual. But first, our mission is just to help people from all levels of society plan for retirement. And for us, that means really the small business community and people in the, excuse my phone's ringing, in the small business community that really are the ones that are suffering the most and not having retirement savings. And our team, we have 20 years of experience building financial technology. So it's using technology to invest and find ways to make us a process or that can be really daunting, investing your money really simple for the user, and also do it in an affordable way. So these are the stats that I just always like to start with. Only 40% of employees that work for businesses with less than 100 employees have a retirement account. That number actually goes down further when the business has less than 50 employees. So it's really, the problem is countrywide, regardless of what level of employment you have, but it gets even worse as you get into the small business community. When we talk about Social Security, the average payment after the Medicare deduction is less than $1,900 a month. But when you actually get into the immigrant community and the Hispanic Latino community, it's even less than that. It's about 27% lower, less than $1,400 a month, and that's the average. Of course, there are people that are below that. How that works, by the way, there's a formula that the Social Security Administration uses that considers 35 years of employment in the country, and your wage. As many of you know, you contribute 6.2% of your paycheck to Social Security. So if you've only worked, say, 20 years in the country, or you just weren't earning a high wage during those 35 years of consideration, your benefit when you retire is going to be even less. And that's a big problem in the immigrant community. Even worse is that ITIN holders don't qualify for these benefits. So it really becomes kind of a dire situation if you're an immigrant not earning a lot and you're trying to plan for, or lean on the Social Security Administration for your retirement funds. And as most of us know, living in any major metropolitan area in the U.S., those numbers just aren't going to cut it in terms of your cost of living. And then lastly, inflation continues to happen in the background. We experienced a lot of it after COVID. It's happening 3 to 4% per year over the past 20 years. And there was a study done by the Department of Bureau of Labor Statistics, that showed that people over 65, the average spend was $5,000 a month for them. And now that's not, that does include people that have those funds and have savings and even income. But the point is, again, just the cost of living is continuing to go up. So what we did is we thought, how can we make it easy for folks to invest, but also arm the professionals like yourselves with the ability to help them and create their retirement accounts. And so, Crecer Connect is a platform where if you have a business client or an individual client, you can actually help them create an IRA. As you see here, we have the ability to add new business clients. And here, if you're a bookkeeper or a CPA that's actually doing payroll for the business, you have the ability to set up IRAs for the employees of the business. And you might be thinking, well, isn't that kind of what a 401k is? And the answer is yes. It's a very similar model. The big difference, which is a huge problem in the small business community, is that most small business owners don't have the luxury of affording a 401k plan. 401k plans can be very costly. And if you're a small business with some part-time employees, you've only got maybe 5 people, or there's a lot of churn, it just doesn't make sense economically for you to offer 401k. And so I say that because we've actually built a model that's very similar in terms of setting up the payroll deductions, but there's no cost to the business because we're setting up traditional and Roth IRAs for the actual employees. The business owner doesn't have to do any matching, and there's no administrative work to actually comply with 401k compliance rules. And so this gives you an opportunity, if you are in that situation, you're helping your small business clients, to say, hey, you can offer IRAs. You can even offer one to the business owner themselves, treating them as an employee. And they have the ability to set that up through payroll. So we'll just go through a quick example of how that works. Here you would just add the basic business information, and again, select whether or not you manage payroll for the business. If you don't, we also have the option to help the employees get set up with their IRAs where they'll contribute directly from their own account. But in the first example, we'll just assume that you are managing payroll for this business. So I'll skip this. It's just basic fields that we ask you to fill out about the business. Once you've added the business clients, you'll have access to adding their employees here. And of course, this is a demo site, so I have some information already loaded. But I'll just quickly show you what it's like to add an employee. You go in and you fill in some information about the employee. Some of the fields are required, some of them are not. The more you fill in, it just makes it easier for the employee when they go set up their IRA account. And one thing to call out here is that, again, we are trying to really help the immigrant community. So we also support ITINs, and we know that that's a big problem with a lot of immigrants that are trying to get their establish their presence, I should say, in the system and create brokerage accounts or investment accounts. A lot of firms won't support that, but we do support ITIN holders. And then on that note, we also the service is completely translatable in Spanish. So, and that's also for yourself as an administrator. If you prefer Espanol, you can do that here. Otherwise, we'll just go back to English. And what you're saying is here, what language we should communicate to the client in. And once you've added the information for the employee in this case, and you click Add Employee, the employee is going to get a link through text and email to create their IRA. And so you're not, going back to what Nadia is saying, you're not providing financial advice. You're just kind of assisting them. And we have this administrative dashboard. It's really up to the employee whether they want to continue onboarding. And I'll pretend I'm an employee now and I'm getting a link here. And it's going to say, your employer, Acme Corp, wants to help you contribute to your retirement. Sign up to start. And so a lot of the problem with the community is just the education. That's another thing that we're really big on, is helping people understand what are the benefits, all the things that Nadia just talked about, but trying to summarize it quickly. So we have some information here on this page before the employee even decides whether or not they want to proceed. The cost, by the way, if you're wondering, is we charge $5 per month or 0.3% annually once the balance of the account reaches $20,000. And then we also have a program where it's if the account balance is less than $1,000 in any given month, it's free. We don't charge the employee. We're trying to encourage folks to get started. And these rates are very competitive. It's a fully managed service. And so I'll quickly go just through this. Again, this is just trying to educate the employee. What is the concept of compound growth? There's some examples. We also have some videos that you can share on these same topics. Nadia just did all the tax savings. We have the tax deduction for traditional IRAs. We talk about the savers credit. And so if the employee says, okay, great, I want to do this, they'll click continue to create your retirement account. And they're going to be creating their account directly with Crecer. And so they'll have the option to move their account in the future if they change employers or start contributing directly. So we try to give the flexibility directly to the employee in this case, so that they're not, kind of tied up in the payroll system or with the employer if they decide to change in the future. And so we do a tax ID match for security reasons, the same ID that you entered when you were creating the account initially for the employee. And this is a fake user called Andres Diaz. And so all the information that you have entered is going to be here. And if there's a typo, the employee can correct it. If not, they can just keep going. And they'll get to the option to select traditional Roth IRA. We just talked about all the differences, but if there's the employee themselves wants to know, how do I choose? There's a lot of educational material we have here. There's a video. We break down table differences between the taxes. Another benefit of Roth IRA, by the way, especially for the small business community, is that you have the flexibility to withdraw your contributions at any time. A lot of things happen in life. You might be in a jam. People need to pull their money out. And so with a Roth, because they're after tax contributions, somebody can pull out their money before they're 59 and a half, and they won't pay any taxes or penalties on the money they've contributed. So in some ways, we don't really like to say this, but you can almost treat it like a checking or saving, I should say a savings account, where it's like, hey, I can leave the gains in there, and hopefully they can leave everything in there. That's the idea of grow over time. But if things do happen, you have that flexibility with the Roth IRA. And then we do make them confirm the income limits, and these are getting updated in 2026. And this is where the system is fully automated. So one of the other big problems of why we have this kind of situation where there's not enough participation with folks having retirement accounts is people don't know how to invest. They don't really know how to get started. As I mentioned earlier, it's a really daunting task. So we have an algorithm that's trying to make it really easy and to manage the investment for the user. And so this is just a personal preference. There's no right or wrong answer, and it can actually be updated later. But the system is trying to measure the user's risk tolerance. So we say, if your investment account lost 15% of its value, what would you do? And it's just a personal question. So in this case, we'll just say, do nothing and wait for my investments to recover. We have a similar type question, which best represents your objective for your investment account. I'll say grow my account at a moderate pace, accepting some risk for potentially better returns. And so what happens when the user eventually creates their account, we're going to factor in their age and their answers to these questions. And it's going to throw them into a portfolio that we've created of different ETFs, which are exchange traded funds from Vanguard. And those are really conservative portfolios that are buying the entire stock market or entire US bond market and some international stocks that automatically adjust for the user. We're not doing anything super exotic. We're again designed for lower income small business community. And so we want to make sure that we're just managing very simple kind of long-term investments for the user. And I'll keep going just to a few more steps. So here the user's going to confirm their birthday, the address that you entered, Again, we support different residency statuses, whether it's a US citizen or ITIN holder or visa holder, and we're required to ask these as a financial institution. So we go next. And then this is where, if you are managing payroll, the user will have the opportunity to select, the employee in this case, how much they want to contribute to their retirement account. They can do a percentage or a fixed amount. The minimum, by the way, is only $50. So again, trying to help folks that may be a little apprehensive in creating their account to get started. And there's a few more questions we ask. Once the user is done creating their account, you as an administrator will get an update that says, let's assume it's Isaac now that finished creating his account, that a payroll update's required. You'll get an email, and you can go into any payroll system and set up the direct deposit for the user. In this case, Isaac wants to do 10% of his paycheck, and you can click show funding details. You'll have just a warning message to make sure you enter it correctly in your payroll system. And we create an ACH deposit account for that specific employee. And so you'll have the banking information here, and you can go into any payroll system that supports direct deposit, which is pretty much everybody these days. And you can do what's called a paycheck split. So 90% of Isaac's paycheck would go to his personal checking account, and then the other 10% would come into his Crecer retirement account. And in the future, if he changes that election amount, the administrator will get a notification, and the banking details will stay the same, but the percent amount will change, and or if it's a dollar amount, and then you as the administrator would have to go and create the account, or sorry, update the account. Now you might be thinking, that's great, I don't manage payroll, I just want to help my individual clients during tax season. So it's actually a very similar process. Instead of doing manage business clients, you go to manage individual clients, and it's the same exact form as before. You're filling out the information for the user. They're going to get the same link. The only difference is, instead of getting this question about how much they want to contribute from their paycheck, they're going to connect their personal bank account through Plaid. Many of you have probably used Plaid, but it's a secure way to connect the user's checking account with our system. And they can, the user in that case can do a one-time deposit, or they can set up monthly. And starting Jan 1, the customer will have the opportunity to select what year they want to contribute in. So right now, everything defaults to 2025, but starting Jan 1, you have the option to contribute to 2025 or 2026. Up until April 15th, you can contribute to the prior year. So if you want to do some last minute catch up and maybe reduce your tax bill before you file April 15th. Last thing I'll say here is that we do, again, financial education is really important to us. So we have some videos that you can share with users. We've intentionally kept them very short. I think the longest is 3 minutes. And it just talks about the different concepts of investing and some of the benefits of investing in an IRA, since that's all we're focused on, like the Savers credit, some of the stats that I shared earlier with relying on Social Security. And yeah, there's a lot more I could share and say, but I want to be respectful of our time and give time for questions.
Thank you so much, Amir. We have an excellent question. So it's a question is, what's the difference between having my client refer them to Crecer versus like Fidelity?
Mm-hmm.
And I can just tell you on personal experience, I do have clients that are not very English speakers, so they're super efficient with their Spanish, their native language. So I see the benefit here that this information to them comes in their language, and they can also offer these type of benefits to their employees, and which are probably most of their employees are also Spanish speakers. Which I think when I had a conversation with you about California has a rule now about you have to offer retirement to employees in California. So this would satisfy that.
Yeah. Thanks for prefacing my answers. Yeah, because I'll take those in order. I think one is it's fully translatable, not only here on the website, but also the customer support team. So whether it's phone or email. The other point that we've heard a lot over the years, and especially recently as we've kind of hit the road more on this product, is the taxpayers are saying, I send my customer to Fidelity or the bank. They don't actually end up doing it, or they call me and they need help. Here, it's, you can really sit down at the table with your customer and help them out if you wanted to. And we try to keep it as easy as possible. The other thing is Fidelity does not have like an IRA employer set up the way I just showed it. So they're really going to try to sell you 401k. Pretty much everybody's going to try to sell 401k, and 401ks are great if you can do it. But a lot of the small businesses that we support, I mean, I had a gardener in California we set up a few weeks ago that has just himself and 2 other employees, and he's getting a $300 a month quote from ADP to do 401k. And he's like, I just can't do that. It's too expensive. And there's the administrative burden that comes on with it. And so it's a good segue. In California, there is the state mandate called CalSavers, and we do qualify as an alternative. A lot of folks don't want to use the state program. It's kind of a pain from a tech perspective if you're an administrator to manage, and then some employees just don't like the idea of the state managing their funds. So we can be an easy alternative.
And also with the 401k, yes, ADP charges 300 a month, but they're doing all these 5,500 forms. It's called 5,500.
Yeah.
But you're saying with CalSavers, having them open this type of IRA through their employer would qualify as a retirement account.
Yeah, we're helping people left and right that right now. So the business still has to register with the state, but then they can say they have an exemption because they're already offering a plan to their employees. What's buried in that exemption that everybody just assumes it's like a 401k or a simple or SEP is actually a payroll deduction IRA, which is what we're offering. And so again, there's no cost to the business. So if it's a small business and they don't want to do 401k, this is where it could be a good fit.
And I think it's a great start, even because you said there is no charge from Crecer for $1,000 of a contribution, right?
For
If
a
you
balance of $1,000. Yeah.
have 1,000 or less, and I think it's a great at least start for our type of clients of, do at least 100. You're not going to get charged anything. Just go through these steps, understand the education, especially this, like you're saying, that we do the handoff. If not, if our type of clients that are Spanish speakers going through Fidelity, it's going to be phone calls to us.
Yeah. And for that handoff, because we know everybody's time is valuable, we do offer a referral fee for $50 per client. Now it has nothing to do with the client funding their account as far as like their balance. You're not doing financial advice. It's more leveraging our platform for the administrative work that's required. And also if you do, eventually decide to share some educational content, we're going to build out that functionality even more in the future. So yeah, we understand that everybody is busy. So given the time that you're going to put in, it's a $50 referral fee per client.